Welcome to the monthly 3-Edge View from the Edge for April 2025. I'm Fritz Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3-Edge Asset Management. And as we do each month, Eric and I will provide our most recent outlook for the global capital markets, and that is based on our 3-Edge proprietary research model. We have a great deal to cover today, so let's get started. But before we dive into our model research and our outlook, obviously the big news this past week occurred on Wednesday afternoon when President Trump announced 10% tariff on all exports into the United States. Meanwhile, China will face tariffs of over 30%, and the European Union's tariffs will come in at around 20%. The tariffs announced by the president were more severe than initially anticipated, and reaction from global markets came in the form of a swift, broad-based sell-off across global equity markets. However, this isn't the end of the story, since the countries that account for the largest share of exports into the U.S. are very likely to take retaliatory measures against U.S. exporters before seeking to begin negotiations with the Trump administration. So the path forward for the global economy and the markets remains highly uncertain. Last month marked the end of the first quarter of 2025, and the theme was this heightened uncertainty driven in considerable measure by the Trump administration's impending tariffs, which obviously have now been announced in the past week. The first quarter, U.S. equities struggled. Investors rotated from U.S. into ex-U.S. equities. The S&P and the NASDAQ declined, while China and Europe posted double-digit gains. And meanwhile, the price of gold rose to record highs in the first 3 months of the year and broke through $3,000 per ounce for the first time ever. Additionally, the Federal Reserve was also confronted by a combination of uncertainty over U.S. tariff policies along with stubbornly elevated inflation readings, and the Fed chose not to lower short-term interest rates at their most recent FOMC meeting. So it remains to be seen whether the recent outperformance of U.S. equities is an opportunity for more gains there, or is it just that they may go down less than the rest of the market. So now that we have the Trump administration's tariff policy, let's bring Eric into the conversation and take a look at what the model research is indicating. And the first thing I'll do is hand it over to you, Eric, for a look at our capital market major asset class matrix. So over to you.
Great. Thanks, Fritz. So a lot of interesting things happening here. We're seeing U.S. and Europe both move down to that mixed to slightly negative outlook. Japan, developed Asia staying in the negative one, and commodities down below moving down to that mixed negative outlook. A lot of moving parts, a lot of data still coming in as a result of the tariff announcement that we'll no doubt be discussing here today.
Excellent. All right, so let's dig in. Let's look at the outlook for the various asset classes, beginning with equities. And let's start with the U.S. equities, which have had an exciting week this week.
Yeah, they sure have. Our model research is indicating that the current outlook for U.S. equities remains somewhat mixed, with increasing downside risks, as we just mentioned in that asset class matrix. There was already concern with the rising prospect of stagflation, that is, stubbornly elevated inflation alongside low or negative economic growth. Now you compound that with the impact of the prospect of these Trump tariffs and the potential for trade wars, and the odds increase. And even after the decline in Q1 you referred to, Fritz, U.S. equities by our measure remain significantly overvalued still. So we believe it is prudent to remain cautious in terms of your overall U.S. equity allocation and to hedge by diversifying across asset classes, particularly by including things like TIPS or Treasury inflation protected securities, gold, and Treasury bills.
Excellent. All right, let's shift our attention to ex-U.S. markets. Take a look at Europe, which, unlike the U.S., they had a stellar first quarter, but now they're facing those tariffs. So what is the model telling us at this point?
Yeah, real divergent performance in the first quarter. European equities had a strong start to the year. You referenced the double-digit positive returns. in that first quarter, second only to China in terms of the major equity markets that we model. Market momentum and positive investor psychology, were those initial primary driving forces behind that rally in European equities. And they received an additional tailwind following the U.S., if folks recall, backing away from the, continuing to provide support to Ukraine. And that has led to several European countries ramping up their own plans for defense spending bills, which may help further boost the region in the near term. All that said, the yield curve by our measure, while steepening, is not yet sufficiently steep to be indicative of longer-term growth in the EU. And Europe was certainly a target in the new U.S. tariff policies, and that's likely to create a headwind for economic growth. So, like the U.S., mixed to slightly negative here near term.
Sure. I'm glad you mentioned, though, that situation with, particularly in Germany, with them now really having to change their constitution in order to spend more on defense, and I mean that is a real change for them. Anyway, let's go to Asia. Talk about Japan, and again, I mean they were positive in the quarter, but they're going to face these tariffs as well from here. So what is the model saying there?
Yeah, that's right. The first quarter, Japanese equities were positive, but just barely so, up just a couple percent. The shape of the Japanese yield curve is a negative factor weighing on the outlook for Japanese equities. The Bank of Japan has slowly been attempting to raise short-term rates, and more recently, we've seen that 10-year yield has been rising faster. So that has led to a steepening in the Japanese yield curve to levels not seen in some time. A steepening yield curve may be a sign of the potential for future economic growth in the months to come. However, like Europe and nearly the rest of the world for that matter, Japan remains a target of those announced U.S. tariff policies, and that's going to create likely a near-term headwind for economic growth. So still a negative outlook for the time being, but the potential down the road with a lag to see potentially a more positive outlook.
All right, now let's shift to emerging markets in China, which is obviously interesting in this whole tariff episode. What are we seeing in the emerging markets and in China in particular, and having now obviously to fold in these tariffs?
Yeah, the emerging market equities, broadly are generally positive year to date, and that's been led by the performance of the Chinese equity market, as we alluded to. We have a U.S. Federal Reserve that had indicated they may slow the pace of short-term interest rate cuts, and that would deprive emerging market equities of the benefits of lower U.S. interest rates. That said, following the administration's tariff announcements, the Fed futures suggest the potential now for 3 to 4 cuts in 2025, and that may actually help to boost the attractiveness of EM equities. Time will tell on that. Also, we've seen a decline in the value of the U.S. dollar in the first quarter, which is another positive factor for emerging market equities, and a further decline following the tariff announcements. And increases in short-term interest rates in China from unusually low levels may also be indicative of growth ahead. So these are all good positives. All that said, there are risks to be concerned about for investments in emerging market equities broadly and China specifically. Most notably would be a resurgence in U.S. inflation, for example, and that could lead to the Fed delaying further rate cuts and would likely create a headwind for emerging market equity investments. Overall, we maintain a positive yet cautious outlook in the near term, as China does, like everyone else, remain a target of the new U.S. tariff policies.
But it's interesting that even in the face of those tariffs, there are a couple, 2 or 3 positives that could help Chinese equities and EM equities move higher. All right, so lastly, we'll look at India equities. What are we seeing there?
Yeah, Indian equities have definitely struggled here in 2025. They're experiencing the downside of momentum investing, for sure. Negative investor psychology has pushed Indian equities into negative territory in 2025. And we've seen their currency, the rupee, suffering losses this year to compound the negative outlook. That said, the rupee has recently recouped a good chunk of the losses more recently. So a bit of volatility on the currency there. So while the long-term outlook remains positive, the nearer-term outlook remains negative. And like other countries we've talked about, India is also a target of the changes in the U.S. tariff policies, which could compound the negative outlook.
Absolutely. All right, let's shift our attention then to the bond market and the current interest rate environment, starting with the Treasury market. What are we seeing there? I mean, they had a very good first quarter, right? 10-year U.S. Treasuries had a pretty nice total return. But what's the outlook now post-tariff announcement?
Yeah, well, you look at inflation, the outlook there, looking at the most recent CPI report, Consumer Price Index, and there's heightened uncertainty surrounding, the outcome of these tariff policies and how they'll be received and what the retaliations may look like from others. So we may get more cuts now due to these policies. That said, the Fed is in a tough spot with regard to cutting aggressively to promote growth, while not cutting to keep the potential for inflation in check. So they find themselves in a true rock and a hard place scenario. With increased volatility in longer term rates now expected, we've already seen some, and it's likely to continue, and a U.S. yield curve that's flat to inverted. Again, our research really prefers concentrating fixed income investments in those shorter term maturities.
Excellent. And tips, I suppose, right, in this environment?
That continues to be a great hedge to a stagflationary environment, which we may be headed into.
Excellent. And then corporate bonds or the credit markets. And I believe we were seeing spreads start to widen out. And I'm wondering what's happened in the last few days in terms of those. What are we seeing in the corporate bond market?
Yeah, we had seen a little bit of widening from incredibly tight levels. Didn't widen all that much though, and then retightened a bit. So any additional yield over and above that risk-free rate, the Treasury rate, is still unappealing at this time. I think if and when spreads widen out more significantly, that may become an opportune time for reinvestment. We just haven't seen that just yet.
All right, so now let's shift gears again and look at hard assets or real assets opposed to financial assets, which would include gold and commodities. And why don't we begin with gold, which, as I mentioned, broke through the $3,000 an ounce mark in the first quarter. What are we looking at there for gold, and how might the tariffs impact the price of gold going forward?
Yeah, this is a great asset here. Gold was one of the best performing asset classes in 2024. It outperformed the S&P 500 last year. As you mentioned, in the first quarter of 2025, gold's up over 19%, and it broke above $3,000, hitting all-time highs. The potential for the Trump administration's tariffs on its major trading partners here, this may cause a surge in inflation, and that could be supportive of the price of gold. We've seen gold respond to investors' concerns over geopolitical conflicts and the relations amongst many of these nations, even amongst our allied nations, and that may help boost the attractiveness of gold as this safe haven asset. And should the Trump administration seek to follow through on their recently stated intention to keep yields on longer maturity bonds, that is the 10-year U.S. Treasury, artificially low, that could involve enacting these policies known as financial repression. That could additionally benefit gold. So, maintaining the positive outlook here.
Gold has had quite a moment for quite a long time now at this point. It's interesting.
Sure has.
All right, let's look at commodities. And they quietly returned, I believe, somewhere around 8% in the first quarter. And so now, of course, we have added complexity with the tariffs. What's the outlook in terms of the model for the commodities markets?
Yeah, well, the prospect of these Trump administration tariffs on steel and aluminum specifically could be supportive for commodity prices in general. You have the threat of an oil price shock that could give rise to geopolitical tensions. Further in the Middle East, that remains a possibility and potentially also supportive of commodity prices broadly. Economic stimulus measures from the Chinese government could also support higher commodity prices. So there's a number of positives here. All of that said, the prospect of these Trump tariff policies rolling through the global economy, creating the potential for trade wars, that really does significantly threaten global economic growth, and that may lessen demand, broadly speaking, for commodities. So, overall mixed, but slightly erring on the side of slightly negative here near term.
I think we saw oil take a pretty good hit once the tariffs got announced.
Yeah, that's right. Yeah, very significant hit to oil. Even gold sold off a bit, although it had run up quite a bit. So time will tell to see how things shake out. All
right. Excellent. All right. Well, thanks, Eric, for updating our outlook. I think This will be helpful to our listeners since the level of uncertainty has certainly increased through the first quarter. And in the last week, we will continue to keep listeners and clients informed as we make our way through 2025. So that will do it for this month's 3 Edge View from the Edge. Eric and I will be back again in early May with another edition of the View from the Edge. If you would like a hard copy of the 3 Edge View from the Edge newsletter, that is always available on our website, which is the number 3edgeam.com, 3edgeam.com. And all of our video content is available on our 3 Edge YouTube channel. So, on behalf of Eric and everyone here at 3 Edge, thanks for listening.